Hey everybody, welcome back to the channel. I'm Doug the Retirement Guy, and today we're doing another breakdown, which is the Nasdaq 100 ETF did the best in the past 120 days. We're putting GPIQ, QQQI, and ROCQ all up against each other. The Goldman Sachs, the NEOS investments, and the JPMorgan. Now we did it for the 120 days because right off the bat, I'll tell you, ROCQ has only been around for a very short period of time. So the 120 days will give us an actual snapshot of how each and every one of these funds have done in the same periods, same conditions, same markets. We'll look at the yield, we'll look at the growth, we'll look at the total return. So grab your favorite mug, put your favorite beverage into it, and sit back and let's see which one of these are going to pull it out as being the best for your retirement portfolio. Disclosure, this information the presentation is for educational purposes only, not for financial, legal, or tax advice. Past performances do not guarantee future results, and I am not a professional trader. Hey, if you don't have your favorite mug, well, you're missing out on, hey, this is our chance to help support the channel. We have an 11-ounce, 15-ounce mug. All you got to do is use the QR code or use the link down in the description below. Order yourself a mug. They are selling quick. And thank you. If you've ordered one, thank you so much. This does so much for the channel, makes things so much easier to produce these videos for you. Thank you so much. But if you don't have your Retirement Made Easy mugs, order them now. We'll get them shipped out immediately. So let me just clarify exactly the building around or the terminology that I'm used on this program. We used the same 120-day window, so we have the same math across the board. It was the April 7th through August 4th numbers. Okay, the formula we use, total return, is price growth plus cash distributions. Distributions included by the X date. And that can make some differences here and there, but I think we captured everything onto this one. We're going to do the no reinvestment assume. So we're assuming you were taking the money off the table and paying your bills with it. Now, taxes, spreads, and commissions are all included. And the ROCQ is new, so history is limited. That's why we broke it down to the 120-day mark. So the big idea is this: the highest payout does not automatically mean the best investment result. So there's going to be people who are going to have the good yield, good return. We're going to have people who probably have some good growth. Then we're going to put it all together for a total return to see who is actually giving us the best total package for our fund. Now, that doesn't mean that's the winner for you. What that means is, you may be a person that needing income. So we're going to have a fund for that. We're going to probably need a person who needs growth. We'll have a fund for that. And then if you want something, a combination, a balanced approach, we'll have that. And it doesn't say that we can't mix these things two together. So we have three similar goals with three different engines. And this is why I wanted to put these particular ones together. And for the whole reason is, you got GPIQ from Goldman Sachs, uses the dynamic call writing strategy. It allows for more upside lift than the other components. And what the dynamic call writing is, if you're not familiar with it, is a 25-75 mix, which is 25% when the markets are really growing and going well and kind of taking off. They'll reduce their call options down to 25% of their portfolio. When the market gets volatile and starts bouncing up and down, they're going to take it and move it to a 75 to collect more income. So they're constantly doing this. And the last report I saw was averaging, in the current times, they were averaging right around about 35 to 40% range. So things were going good. That's why we'll probably see them with more growth than anyone else. So the yield profile is that they are going to be a lower income portion. Their fees will be 0.29%, and the best upside capture is in this window. Now, QQQI, the NEOS package, is an actively Nasdaq 100 index option income strategy where they own a portion. They basically built their own Nasdaq 100 in stocks. Then they go out and trade on the NDX index side of it. And there's a little benefits for that with the tax structure and so on that we'll talk about a little bit about. But primarily what they're doing is they're buying an index today, putting it out there as a call option, and then they may even buy someone else's call option with a little higher link so that they can continuously make and capture as much income or much growth as they can, but they're capturing mostly all income. So this one, truthfully, will be the highest income in the market, which it needs to be with the 0.68% in fees. And so it's the best paycheck that we're going to have with the least amount of growth. And then the newcomer, JPMorgan. Now I'm going to say newcomer, but I want to just clarify this. ROCQ is new. The strategy is not. The company's design is not. What they basically took was their JPIQ ETF. That's one of the largest out there. I think it's over $40 billion in assets. That they basically restructured what they called the problems with it and came out with ROCQ. Now the ROC will mean something, and we'll talk about that again a little bit later, but ROCQ is JPMorgan's call spread premium strategy. So they're doing this very similar, that they're doing a call options, spreading it out, buying other calls to keep the market going. It's a middle of the ground piece, 0.35% fee, so well below market value. And it's a strong early balance, but it does have a short history. So we got to make sure we remember that. So monthly income is very useful. I'm not telling anybody anything different, but monthly income is very useful. But the real test is whether the fund can deliver income without giving up too much of your capital growth upside. There's a lot of people out there that'll talk about these things. They'll have, I get 20%, 25%, but they're losing it in NAV value. As long as we're growing some, we're above the NAV erosion. But what we want to do is, where's that magic line of big enough income with big enough growth to give us a magic touch, which is really where, total return really comes into play. So round one, the cash income winner. Well, I told you before, QQQI is designed for income. They came in at 5.11% over these 120 days. So realistically, we're talking of 120 days, about 4 months. So you're well over basically 1.25% per month of income. Now, ROCQ, the JPMorgan one, came in very respectively at 4.82. So again, they were almost at that 1.2 mark. So very, very close to QQQI. And JPIQ came in at 4.02%, respectively, about 1% per month. But overall, if you're looking just pure out, you want income from your investment, QQQI wins this one. It produces the most income during the 120-day stretch. And the distributions are about 27% more cash than GPI's base on starting at the share price. So, like I said, 27% more than Goldman Sachs, but ROCQ is right there. JPMorgan is nipping at their heels into that market. Number two, share price growth. Told you at the beginning, GPIQ, Goldman Sachs, was going to be the highest growth. They came in at 14.68%. ROCQ, right in the middle, 11.92%. So realistically, I'm going to say 2.5 percentage points, maybe a little bit more below GPIX. But QQQI, which we know is not the growth builder because they're capturing more income, came in at 9.21%. So if you're looking to a boost in your product and wanting some growth, 14.68%, Goldman Sachs is the way to do it. They capture more Nasdaq upside than QQQI and ROCQ. The extra upside matters more than the smaller cash payout difference between the two. Now we take a look at total returns. Now I am a total return person. I look at this always first to see what kind of money we're getting out of this. And then we'll figure out what we want. Do we need some additional growth? Do we want income? And we'll play one against the other. So here's what really come out to me. 18.70% was GPIQ. Okay, the Goldman Sachs wins the game in total return at 18.7%. ROCQ, JPMorgan, came in at 16.74%, so only 2 percentage points difference. And remember, so far, ROCQ has come in second place up against every one of these. And here they're only 2 percentage points down from total return. The positive is that total return, and that is really the difference is coming from income. And then QQQI, the big income players, 14.31, which we know that's an income with a little bit of growth. ROCQ is right in the middle, and GPIQ is more growth than it is income. Now, I put the winner as GPIQ because it does have the highest total percentage. But it tells me right now that we need to be seriously looking at JPMorgan's ROCQ for using it in our 3-bucket retirement system. Now, remember, guys, the breaking news. Released this yesterday. Well, I have to say when we're releasing this video, but on 8/12, we announced this immediately when we got the news from it, the breaking news. Goldman Sachs is actually buying out NEOS. Okay? So I have a complete video on all of this. Don't be afraid to go look at it. It's very, very interesting information. If you own any of this, if you own Goldman Sachs or NEOS, either one of them, you need to watch the video to answer a lot of different questions and things that are coming up. And we'll probably be doing some updates on this because this is a huge thing. Now, right off the bat, I'm going to tell you, they're buying NEOS as a company. They're not buying the funds. They're not liquidating the funds. They're not doing any of that. They're actually just changing the ownership of the company. Management, primarily management is going to stay in place. We have a lot of questions about it, but this is what's unique. I've been saying this on my channel for a while to use the Goldman Sachs and NEOS working together. Now they're going to both be under the same roof and under the same company management with different managers across the board. I'm just waiting to see how this is going to come out all the way through. But I wanted to let you guys know that. It's not that I'm skipping it, but real importantly, the Goldman Sachs buyout. So let's take a look. If you took a $10,000 investment, put it in each one of these, where would you be sitting? Well, with GPIQ, you'd have $11,870 in your portfolio. Now, I know that's assuming you didn't take any money out on this particular screen. ROCQ, JPMorgan, would be $11,674. So you can see there's only about $200 difference. But the one that get me right here was $439 difference in QQQI. So a lot of people think they want growth. They want to continue adding to their portfolio. They want it to continue getting bigger. Well, you can see where the difference comes into play. So the big lesson here, yield did not win. QQQI paid the most cash, but GPIQ kept more upside, and ROCQ landed right in the middle of the two. Now, for retirement income, the big question is not just how much money do I get paid. The better question is, did my fund deliver income while protecting and growing capital? And the answer to it is all three of them actually have done that in the past 120 days. So where are you sitting and what do you need? Do you need more cash? Do you need more growth? Or do you want to be in the middle of the road? And I think we have one of each one of these funds answers those questions. So which fund fits your retirement goal? As I said, if you're a guy looking for income first, like myself, I'm an income guy. I want income all the way through. Well, QQQI would be where you want to start at. Now, if you want income with a strong total return, now remember, that does not mean strong growth. That means income plus strongest total return. And you need to break down your total return to get the true answer, and that would be GPIQ. Now, the balanced new challenger is ROCQ, JPMorgan. And here's what I'm trying to say when I say that you got to break your total return down. GPIQ has income, but has mostly growth. Now, QQQI has monthly income with some growth. Well, ROCQ that we've showed so far has a good growth and a good income that they're the balanced approach challenger. Now, if this thing was newer, if we had a year under its belt, I'd be all over it saying, guys, I think ROCQ is a great place to be. But we have a short distance. I trust JPMorgan, but I just got to wait with my standards and my way of doing things. I got to wait till I get more history. I'll probably miss some growth, but overall, we're here for the long haul, not the short sprint. So your retirement income bucket depends all on matching the fund to the cash flow you need, the tax account, and the risk tolerance. So the big question has always come into is you don't pick an ETF by headline yield alone. That's the biggest mistake people will make. You have to check the strategy, the NAV trend, the distribution support, the tax treatments, and the operating history. Now, we've covered a lot of these funds already on the channel, so there's videos out there on all of these from ourselves to give you a true point. And we're always constantly updating them. And we're going to update them a lot once we get the whole thing with the buyout going on, which is going to happen in the first quarter of next year. But I'm telling you here is one thing I always get from people is, well, I got to pick between QQQI or JPIQ. And the answer is no, you don't. The answer is, why can't you do what I do in my 3-bucket system? My income bucket has a core product, has a satellite product, because what I normally do is in my income bucket, I'm dialed in. I want income all the way through. So QQQI would be more than likely my core product. Well, I just want to make sure we get a little bit of growth on top of that to cover inflation and to help in case the market does turn negative or turns down. Well, this is where I'll put JPIQ in as the supporting link, because I'm going to take that strong growth with that strong total return, put it with a fund that has great growth or great income, and I get the best of both worlds. It's called my cake and eat it too. Now, the other thing is with those two coming together in the same house, will they stay the same? I don't know, but I already have an alternative in ROCQ. That could possibly be a really good one that if I need more income, put that in, and it still has a good balanced approach with that it does have some growth. So the answer is which fund fits? It should be which funds, as an S, will fit your portfolio. Which one works the best for you? I'm just giving you some suggestions of how to work with these things. Remember, I'm not the financial wizard. I'm not the financial guy, licensed financial guy, but I've been retired for 10 years. And I've understood how these things all work together. So in the final verdict overall, well, we're going to say GPIQ is the best because it won the total return and the best growth. But I think the quiet one right now that a lot of people are missing out is ROCQ. The early strong balance, the short history is what only holds it back. Now, I told you earlier, I said the ROC is going to mean something. Well, JPMorgan, the biggest problem with their funds is they had no tax planning. They had no tax issues. Most of their stuff came out as ordinary income. Well, they called all of their new funds ROC something, ROCQ, ROCY. Guess what ROC stands for? Return of capital. That's right. ROC funds, these are the ones that they fixed with their tax programs of using return ROC. Now, ROC, I've talked to you about a lot, about being as a tax piece. But you know what's really happening? If you guys haven't seen this yet, and especially if you're getting into retirement and we're learning this, ROC is a huge advantage when you get into healthcare. Because ROC, return of your own capital, doesn't count towards your income. And we're going to have a video on healthcare because we've gotten so many questions. What do you do before you get to Medicare? How do you handle your healthcare? Well, one of the big factors is ROC does not count towards the Affordable Care Act. So you could actually help get government subsidy on your on healthcare if you're putting money into ROC. This is why planning in retirement is so big. Now, QQQI, yeah, it's got the best tax advantage across the board. It uses ROC as well. Same thing with GPIQ. So there's so many things of the puzzle that we need to put together. But across the board, guys, this is how I ranked it. Number one, because of the total return and the best growth. Strong balance between the two with the JPMorgan. And the best total income is QQQI, but it does lag some growth. So how does it fit in your portfolio? Let me know in the comments below. I'd love to hear how you guys do it. And if you at all know what's going on with the Goldman Sachs and NEOS, I'd love to hear your opinion on that one as well.